Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter like we normally do. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's just dive right in, take a look, see what people are sharing. If you want to follow me at Fair Finance, and if you want to join our community, finding-value.com, we've got a discount specials, that discount coupon code you can use. You can check the description link for the discounts. And if you're interested in investing and really want to learn strategies and macro and all sorts of stuff, definitely join. There's a whole bunch of us talking about this stuff every single weekend on a Zoom call. And then I do midweek updates of what I'm doing and the companies that I'm watching. I'm a long-term investor. I'm not a short-term trader. I generally stick with a core group of holdings, and then I try to pick off the cheapest price possible for those core holdings. That's kind of how I operate. I've researched the companies quite thoroughly. We can talk about the companies if you guys like and the fundamentals of them, but they were selected based off of technicals and fundamentals, and some of the characteristics that they have for valuations, upside potential, some of the reserves that they may hold, and the type of reserves they hold. So, natural gas versus natural gas liquids versus oil or heavy oil. So I look at all those things and I share it with everybody. And generally, you get a lot more confident understanding the company. I also go over the conference calls of those companies that I follow, and try to gain even more conviction to hold on. So correlation economics says you don't believe in the 10x leverage in gold juniors. Watch me. If gold rises 10%, they will go up 100%. If gold rises 30%, they will go up 300%. If gold rises 50%, they go up 500%. What he's talking about is their margins. Companies, when they go up, what drives a company higher is a couple of different things. Those things are money flows coming into the sector. That definitely drives those prices of whatever sector is getting money flow in. It drives the prices higher. Um, what generally drives prices on the long term is earnings per share growth. Earnings per share growth comes from making more money. In commodity companies, it comes from the commodity price going up, or the commodity price to stay at a higher level as they sell their commodity into the market at higher prices. And that eventually results in a large increase in earnings per share. And that earnings per share is generally what drives a company upward, at least sustainably upward. If you look at companies that don't have earnings, what you'll see are big boom and bust cycles. They go up a lot and then they bust really big to the downside. That's because they are reliant on money flows, and they don't have anything sustaining the move if they don't have any earnings. So you'll see big boom bust cycles like in uranium, in small junior gold and silver companies. So those have an expiration date. They go up, they expire, and then they go back down because they don't have earnings. He is describing the earnings leverage. The earnings leverage, when you get to a certain point, if you're a high cost producer, your leverage is your margins, and the stock price goes up for in relationship to your earnings per share. So your margins or your earnings is leverage to the commodity price. So if the commodity price goes up 10%, your earnings may be impacted by 100%. That's your margins. If gold rises some other percentage, it could be multiple hundreds of percents, and that's where you get the big moves in commodities in short periods of time. Um, in the mid 2000s, oil went from, I think, a bottom of about $10 a barrel to $150 a barrel. That's a 15x in terms of commodity pricing. Now, when you look at the margin expansion and their earnings per share expansion of those companies, Some of those companies went up 40, 50, 60, 70, 100x. So they went up 100x. What drove it was their earnings expansions growing. And then obviously, it's not just earnings, it's how much people are willing to pay for the company too. Your price to earnings is your multiple that you put on the earnings. So there's all those things that you can learn from a fundamental perspective. But a lot of it really just comes down to the commodity price. And with gold rocketing higher and with the really low, we'll call it gold miners to gold ratio, some of these gold mining companies could do many multiples in a very short period of time. All it needs is money flows back into the sector. And that will occur when people get sick of losing money in other sectors. And then they'll FOMO into it, fear of missing out. Eric Nuttall says 60 WTI or below is the death zone for US shale. Looking to Baker Hughes' rig count on Friday to validate our view of over 0.5 million barrels per day of exit. Exit declines if price weakness persists. It equals the estimated demand loss of 0.5% drop in global GDP. And he's got US shale production growth. This is what is projected going forward. You can see that growth is really slowing over time. This is time. This is your growth. Your go forward demand growth is this dotted line at about 1 million barrels per day. If you notice, we're well below the 1 million. Permian is making up less and less production throughout the world to meet that demand. And this is where the big question mark comes from. As this declines, and if you're below $60 a barrel, it's going to decline even faster. We could go negative here, which means that if demand stays where it's at, roughly speaking, we need projects from other areas to come online. OPEC could very well come online with some of their spare capacity to fill the gap. How big is this gap going to be if we stay below, say, $70 a barrel and supply keeps coming offline? So that's the big question mark. I think within a few years that the projects that are out there, they kind of run dry. There's not a whole bunch out there, especially at the pricing that we're at today. And then there's this demand, or I should say, this supply is going to go down. It could even go negative. So that's where things get real hairy. Spare capacity will be eaten through probably this year or next, and then we'll have to see what happens. And that's where I think the real fun's going to begin in the oil sector. It's going to get real hairy there, guys. Real hairy. Few years out, maybe year and a half to 2 years out. Hey, you might like this. Silver miners have broken out versus silver. It's go time. So SLV, so this is SIL divided by silver, and we've broken out here of this little consolidation with volume confirmation. Looks pretty good to go higher for SIL ETF. The US dollar can't hold a bid, elevator down to 90 in the months ahead. And we're at support right now at about 100. If we can break through 100, yeah, I think we're going to go lower, probably to 90 quite quickly. What does that mean? Well, for commodities, as the dollar declines, it's going to be a tailwind behind all the commodities because they're priced in dollars. And that also will impact money flows. Money flows are going to leave United States dollar and dollar denominated assets and go towards currencies that are strong and stronger markets. So you'll see a large rotation of money out of the United States into other currencies and other markets out there in their stock markets. I'm listening to uranium, or I'm listening, uranium is this, uranium is that. But somehow none has answered a simple question. What changed to the uranium thesis and fundamental picture compared to a year ago or two? Anybody? Well, I can try to answer it. Uranium doesn't go up just because of sector fundamentals. It goes up and down based off of commodities, based off the dollar, based off interest rates, based off of money and sector flows around the market. Uranium has gone up just like all the other commodities during commodity bull markets. So recently, we've had a lot of strength in NVIDIA and a lot of tech. Money's been sucked up over there. When that starts to decline, which it is, I think money's going to start to look for new sectors to invest in. And uranium, with its great sector fundamentals, is one that could steal some money from other sectors. And that's called money flows into it. So nothing's changed from the uranium thesis. There's nothing that's changed from the commodity bull market. There's nothing's changed from a valuation standpoint of hard assets um, versus financial assets. So nothing's changed. Absolutely nothing. And you should be in the undervalued assets. It's going to protect you against the overvalued assets that you could see. So now here's another thing. Commodities just in general are stupid volatile. So somebody would say, well, uranium still went down more than, say, some tech company or whatever. Wait until it goes up. When it goes up, it's going to fly. So that's why we're here. The whole purpose of investing commodities and getting kicked in the nuts like 6 or 7 times all the time is because of the upside potential. The upside potential is so ludicrous that you don't see it in other sectors. And the reason it's so ludicrous is when I was explaining the gold mining earnings per share, it's because commodities, when they get out of balance, they can go up dramatically and the margins of the companies can just go ballistic. So I think, and this is my opinion looking out in the future, I think the deficits are so big that I don't know how they're going to fix some of these deficits. The demand will get destroyed. So you go from riding cost curves in a bear market to a bull market that is demand destruction pricing. Demand destruction pricing is going to occur across a whole bunch of different commodities. Copper, uranium, oil, a whole bunch, natural gas eventually, all of them. And the pricing of where we are today to what demand destruction pricing is like leagues away. It's not even the same market. You wouldn't even recognize these companies. Some of these companies are going to be making more money in 1 year, free cash flow, than their entire market cap. Their entire market cap. So that's going to come towards the end of the bull market. Right now, there's all this fear, there's all this stuff in the market. Maybe the recession could come. It's very difficult to know. And that right now is causing a large mispricing of assets. And that's your opportunity. Your opportunity is the large mispricing of assets. Parallel Systems broadcast, it says, if you trust the narrative that Trump and his team are here to save you, buy the rally. If you believe in cycles, history, and that we are heading into a financial reset, you need to study the chart like your life depends on it. And I think that's a false, I think that's called, what is that, like a red herring? Or he only gives two options. I think there's more options than that. But Dow Jones from 29 to 32 bear market, you can see the stair step lower here um, in that bear market. And that's some of the things that I study are these stair stepping patterns. But 1929 to 1932 is a completely different market condition than where we are today. That was a real estate bust, and the banking system was done. I mean, it was done. So I don't think you can compare this. You can, markets move similarly for sure. They're going to have this stair step pattern, but I don't know if this entire move lower will be the same. You could state that the deficits in commodities will be so bad that maybe the pricing of financial assets are just completely mispriced for what I think maybe could be coming, which would require their inputs to have problems. So a company, the way it gets priced is you've got a price to earnings ratio, and let's say it's really high, like 60. So if a company is getting priced at 60, it's priced at 60 times its earnings, which is very expensive. And if there's a problem in the future where the future cash flows become questionable, people will discount it down from 60 to some lower number. It's possible that some of these companies can trade in single digit price to earnings ratios from 60, which means you have a very large decline in the price of that asset. In other areas, like commodities, their price to earnings ratios are like 5 and 3, which means there's a lot of expansion in their valuation that can occur on top of them increasing their earnings per share. And that's where you get those big, huge returns. Their earnings grow by 10x, and then you get another 2 or 3x on top of it from earnings expansion, or maybe even more than that. So that's where it all comes from. You buy cheap assets at very cheap prices, and then the market conditions change to a favorable market condition for the commodity, and then your earnings blow out, your um, valuations also become more expensive, and you get just a humongous return, 10x, 20x, 30x, 40x, 50x in a very short time frame. Please tell me what gold is warning us about. Well, here's my guess. I think gold is warning us about a potential problem in the bond market. And people don't want to own bonds anymore. They don't want to own United States American bonds. We can see that in the increase of yields. So I think that the market is telling us that there isn't very many options in the market for people to buy bonds, and they're not choosing those options, and they're choosing gold. So when people start to distrust other countries, when they see what's coming, and they're putting tariffs and all this other stuff on it, they don't want to trust the country, and they say, you know what, get me out of here. I'll just buy gold, and that's their alternative to store purchasing power over time. That's what I think is coming, and I think that's what gold and an increase of interest rates is telling us. Because when it comes to mining, all I really care about are the green arrows. In this chart I've made, exploration works well in some commodities where the geology is consistent, but the best risk reward comes from buying in what he calls the intrinsic energy compression zone. That's the point where someone else has invested a huge amount of energy in a property and it's trading at a massive discount to that value. The snapback or bounce back is my bread and butter. Life is short, so I focus on these moments in different commodities and spend the rest of my time away from the office out exploring the world. It's very rare that I'm not rewarded when I follow this strategy. Dilution while waiting for the rebound is the main risk. But when you buy things at a 90% discount to the energy invested in a good asset, it's just a matter of time until you get paid. Over 5 to 10 years, I'm always confident I'll get 2 to 3x at least. But very often you can see 3 to 5x in a couple of years, or a plus 10x, that's a 10 bagger, when both demand explodes and supply suffers in your chosen sector. For your information, I've arbitrarily drawn in a couple of bear markets on the typical Lassonde curve. They can happen at any time. During exploration, expect a 90 to 95% loss or more. When producing, 80 to 90% losses are common. I like owning things that are thrown away and only need time to revalue them. Uranium stocks in particular are in this phase right now, despite the bull market and nuclear power just ramping up. Stocks got way ahead of themselves and have corrected sharply. So I've been buying. Note, I stop the green lines short of the peaks. I don't try to get every last dollar out of the bounce. With eyes open, we can often find another sector to roll into that presents far better risk reward after the bulk of the recovery has occurred. So it's the green arrows. The green arrows is the intrinsic compression or energy compression zone, bear to bull rebound. We have another speculators leave, and then operational improvements, another one down, and this is the intrinsic energy compression zone from bear to bull rebound again, right before it goes to ongoing mining. For the uranium sector, I actually have, I would say, maybe 3 or 4 or 5 different companies that are right here in this Bambaro bounce 10x potential. They've got stuff built, or they've got all their feasibility studies done, and then they are building for what is going to be a higher move into ongoing mining out in the future. I do think that there are better, I'll say better risk reward plays in the market than even some of these uranium companies. The reason being is there's still a lot of risk in building a mine and doing all that. There are companies that have all the infrastructure in place that are just completely out of favor, and all they need is the commodity price to go back up, and then you can get your 10 or 20x potential. And you're paying nothing for the assets that they already have. So that's your price to book or price to net asset value is where you get that. And where the big discrepancy comes with most people, what most people try to do is they try to time the market saying that this company will go up during this time frame. And that is where the majority of people make the mistake because timing the market is incredibly hard. So the way that I would prefer to do it is you identify where the value is in the market. So, okay, this is cheap. I'm going to go buy a bunch. But that doesn't mean it will necessarily go up immediately. Some people will then argue, well, that is an opportunity lost. So you should have waited for the breakout. But sometimes the breakout is like a 3x in the making before it breaks out. So you lose a lot of your potential upside return, and it's a lot less risk reward than would it be buying lower but being more patient. And that's where the big debate is. The big debate is do you buy and try to get as low as you can, which I think is the correct call, waiting for the market conditions to become favorable for that sector or commodity, whatever you're in, and then you get the big move. The big move, the difference could be a 3x versus a 30x in some of these moves. And it is dang near impossible to make that up off of an opportunity. Some people think it's an opportunity loss, but I don't know how to make it up. The returns are so much different that I would much rather be willing to be allocating some money to a sector and having that sector appreciate far more because I bought closer to the bottom and had to wait for that inflection point, we'll call it. But that's where the big debate is at. So a lot of people, if you listen to them, even in the comments section, they keep telling you this is what's going to occur. This is what's going to happen. They're making predictions. They don't know the future. And they may disagree with what I think is going to come. But all I'm doing is buying the value at the bottom. And there are other strategies and methods that you can deploy where you can be wrong in one sector, be right in another sector, and still make a bunch of money. The problem that most people have is that they get bullish at the bottom of a sector, or they get bullish when it's already broken out and they're more towards the peak because they try to chase price performance. They say, well, this has been going up for a couple of years. It's going to continue to go up. That's where they get it wrong. You almost have to buy at the cycle bottom, and there's technicals to look at that you want to buy close here. But it takes a little bit of time for this to come out of that stage one base, we'll call it. So that's the whole kind of difference between different strategies and methods that maybe people try to deploy and make money. Your asymmetry, let's say this is 10x upside and you've got 100% downside. But let's say if you buy really low, it's 20, 30, 40, 50% downside. Even if you buy low, some of these still go down. But if you have 10x or more greater potential upside, you can go into 4 different sectors and still make a bunch of money if you actually realize a very good return in just one of the sectors. So you can play 4 non-correlated sectors. I know a lot of these things are correlated. They're all financial assets almost, some of them. They're all kind of linking up. But there's ones that do very well in some conditions, and there's other sectors that do very well in different conditions. And you could put some in each of these sectors, and then the asymmetry, the 10x potential, can lift your entire portfolio up, while the other sector maybe lags. And what that is that's hedging yourself based off of a condition that might be difficult to read. Looks like gold to silver ratio is bear flagging. I saw this one too. Epic sell-off underway. The coming collapse in the ratio could spike silver to all-time highs very quickly. I think this is a good spot to be looking for silver. I'm not just talking physical. I'm talking even the silver miners. They're super cheap guys. Lots of opportunity here. Lots. With gold mooning, I think silver has the potential to really do a catch up move. There's a lot of asymmetry in the silver mining companies. Nobody gives a crap about them. No one. Lawrence McDonald says, "Will the real champion please stand up?" And this is your S&P 500 stocks going down and gold ripping higher. And you can see that disconnect that is coming here. We had further disconnects in history like that before in 2020. Oil cracked, in case you are wondering why there is still a 26 per barrel disti crack. So that's your crack spread, with the economy apparently going to zero. So look at your distillate stocks, U.S. distillate products supplied up, and this is your inventories are at minimal levels. So we need to convert more oil, heavy oil specifically, because this is distillate stocks, diesel, which is really, really low. So your demand is high, your um, inventories are low, and this is where we all get confused. It's like, well, your pricing is going to go up, and somehow your oil price is way down right now, which is weird. Because then, if your oil price was higher, you would have a little bit of a compression sometimes with your crack spreads. Your crack spread is converting oil into a usable product, gasoline, diesel, whatever it is. Freight futures AM update looks like dry bulk was up big. Capesize up 7%, Panamax up 7%, and tankers VLCC is flat and Suezmax up 4%. Jordan Roy uh, Bjorn, however you say it, the greatest breakout of all time. In my book, I mentioned it was the commodity prices in 1972. But to be more specific, I will include this in an updated version. It was really gold in 1972. It took out a Depression era peaks and the Civil War peak. The cup and handle, while extremely significant today, is just a pause in the way of gold's impending parabolic move, which will end with gold backing in the money or in the monetary system. So there was the big breakout. This was a 1, 2, 3 hump, and then we broke on the fourth all the way up. And then we had another consolidation break, another cup and handle consolidation, and a breakout. So we're in a full-fledged bull market of gold moving higher. It doesn't mean that every single day it will be up. Right now, we have a setup in silver where it's got a big like cup and handle just like this. And then we're about to break out. 35, 36, 37, $40, somewhere in that range is that sideways going across move, depending on what time frame of candlesticks you're looking at. It's lower on the yearly close time frame. It's obviously way higher. It's like $50 maybe at a daily candlestick time frame. Silver's going to do something like this after it breaks out. And gold's already ripping. That's our leader. Great news, the big beautiful bill is coming along really well. Republicans are working together nicely. The biggest tax cuts in USA history, getting close, Donald J. Trump. So right now, everyone's pricing in a recession. I'm wondering if you get these gigantic tax cuts, it's possible that this could be very positive for America. So what he's doing, and I hope this works, is that he's basically putting on a consumption tariff tax. That's consumption. And then if he can remove income tax, that's going to be huge. That's what I hope he does something like that if he can pull it off. But this is him coming out saying that the biggest tax cuts in USA history are coming. And this could impact the markets differently than what we are, than what maybe is being priced in today. So we've got so much news coming out that is changing the what people are trying to figure out. So people are trying to project what's happening in the future in the market, and then they're pricing the market in a way of what they know in terms of current information. But Trump is changing everything underneath our feet kind of quickly, and he has to if he wants to implement it. So basically, he's changed the tariff tax, and I think people aren't thinking about him removing maybe income taxes. So if he does remove income tax or whatever he does here with the biggest tax cuts, maybe it's net positive and everyone's pricing the markets incorrectly. Maybe. Here's one that says tax cuts should benefit the working and middle class, not the wealthy elite or giant corporations. Why? Because when everyday people, teachers, drivers, small business owners get tax relief, they spend it locally, invest in their families, and fuel the economy from the ground up. That money circulates, creates demand, and supports real growth. On the other hand, when billion-dollar corporations get tax breaks, the money often ends up offshore, hoarded, or used for stock buybacks, not helping the average citizen. Fair taxation isn't just economics, it's justice, it's stability, it's the future. I would disagree with this statement on some of it. Teachers, drivers, and small business owners, depending on how much money they make, I think something like 50 or 51% of people don't even pay federal income tax. So the majority of taxes are being paid by high income earners. Almost everything is paid by top 10% or above. Almost all of the tax paid is top 10% or above. So if he does large tax cuts, it's going to impact the bottom 51% by absolutely nothing if it's income tax. If he's going to try to give money back to the bottom 51% and steal it through other methods like taking it from the top 10% and redistributing it, I don't know if he's going to do that or not, but well, that wouldn't be good either. Because I'm not against stealing anyone's property, private property. But most people don't pay that much in taxes. So even if you have large tax cuts, they may not bring home that much more money. So if they're paying in federal a couple $1,000, that's what they would get back, maybe, is a couple $1,000. The people who would benefit, if it's large enough, would be the people who are paying all the tax. So if he had huge tax cuts, it's going to benefit the people in the top 10% the most. If, however, it's written, I don't know how they're writing it. Also, it is really bad to tax corporations at all. Corporations don't pay taxes. The end user does. So when people say, on the other hand, when billion-dollar corporations get tax breaks, the money often ends up offshore, hoarded, or used for stock buybacks, not helping the average citizen. It does help the average citizen because if you don't have any tax, if you don't pay taxes if corporations didn't have to pay tax, they could lower their products, the price of the product, which then means that your price of your product is lower for the average citizen. And it also means that your companies are more competitive on a global scale if they don't pay taxes. A tax is not paid by the corporation. A corporation is just a shield so individuals can't get sued. And then the other portion is when you make money, they have to pay taxes, but the corporation makes all of its money from the average citizen of most of these countries. So it does help the average citizen. And his logic is is not good. You want the least amount of government and you want the least amount of taxes because that is where you are the most competitive. And companies move to the most competitive, money-friendly countries. So you'll have more jobs for the average citizen for less cost for the average citizen if you don't tax corporations at all. Insider trading scandals brewing. Trump's 9:30 a.m. tweet makes it clear he was eager for his people to make money off the private information only he knew. So who knew ahead of time and how much money did they make? That is true though. He did tweet out there. It's a great time to buy DJT. EIA weekly oil report correction. Total U.S. oil inventory. Yeah, looks like we have a ton of oil. Look at that. We're way down in inventory, guys. In fact, we are at the same inventory level as the boom phase of the last oil bull market. Think about that for a second. We were increasing our inventory levels over time, last bull market from 2001 to 2008. And right now we are below those levels. And we have a higher amount of demand, less days of coverage. Think about that for a second. Oil is a huge opportunity. Now, people think this is going to go up. All right, let's see it. Let's see it. Let's see us add oil to or add inventory. It's very hard. Even in recessions, oil demand growth slows. It may not go down. A lot of people think, oh, we'll just kill oil demand. Not the case. Didn't happen in 1990, at least on a worldwide scale. It may not happen today either. We might just slow oil demand growth. Investigation needed. Look at this. This is the amount of SPY calls increased by over 10x, literally 10 minutes before the announcement. Yeah, news gets leaked, guys. News gets leaked. You're going to see the second greatest breakout of all time. Gold in 1972 was number one. Coming up as number two is the impending breakout in silver through $50 an ounce. This is a 45-year long base. This chart covers 170 years. Look at how the base stands out. That speaks how significant it really is. And this is the silver price ready to break to the upside. I think that's a huge generational opportunity here. Now, some people say, well, maybe it'll take a little longer. I don't care. I'm in it, guys. I'm in it. And when it breaks, I'll make so much it doesn't matter. It just doesn't matter. And that's what I'm going to have for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Special coupon code. We've got a Saturday question and answer session coming up, 7 a.m. Mountain Time. We'll see you there. Catch you later, guys.